Stop scrolling, because what just happened in Japan is about to hit your money. A few days ago, the Bank of Japan did something most people ignored. They raised interest rates. Sounds boring, right? It shouldn't, because that single move just triggered the unwinding of a trade that has been quietly holding up global markets for over 20 years. This isn't about Japan. This isn't about policy. This is about US stocks, the Nasdaq, Bitcoin, and every asset that depends on cheap money to survive. And if you own any of them, you need to hear this. For more than 2 decades, Japan was the world's cheapest source of money. Zero rates, negative rates. Global capital borrowed yen almost for free, converted it into dollars, and poured it into tech stocks, bonds, crypto. That trade has a name, the yen carry trade, and it became the largest silent leverage machine in financial history. But here's what just changed. Japan stopped supplying liquidity. It started pulling it back. And when the funding source reverses, the entire structure above it starts to wobble. Let me put this simply. Japan didn't press a button. It pulled a lever. And that lever is connected directly to Wall Street. When that lever moves, money doesn't panic. It leaves quietly out of high valuation assets, out of risky narratives, out of anything priced on optimism, and it goes somewhere safer, back home. This is why you're about to see something dangerous. Not a crash, not headlines screaming panic, but something worse, a slow liquidity drain. Stocks don't collapse, they bleed. Crypto doesn't explode, it gets repriced, and most people won't notice until the damage is done. No, here's the part almost no one is talking about. This isn't a one-off hike. It's the beginning of a regime shift. For the first time in decades, the global risk-free funding currency is changing. And when that happens, every valuation model breaks. Because the math changes, the denominator gets bigger. Prices don't stay high unless cash flow is real. Most isn't. So ask yourself this. If money can earn safer returns by going home, why would it stay in volatile markets at the top? It wouldn't, and it won't. That's why the next phase won't reward growth stories. It will reward survivors. In the next few minutes, I'll show you which assets get drained first, why US debt is quietly under pressure, and where capital is actually moving. Next, stay with me, because this isn't market noise. This is the end of a 20-year money cycle. And missing, it isn't a small mistake, it's an expensive one. It pulled a lever, and that lever is connected directly to Wall Street, US stocks, the Nasdaq, Bitcoin, to every asset that survives on cheap money and borrowed optimism. This is not about one meeting, this is not about one rate hike. This is the beginning of global capital returning home, asset prices being reset, dollar liquidity tightening, and national balance sheets being reshuffled. Money is about to move. The question is, where does it go? Who benefits? And who gets quietly drained? Let's break it down. To understand how this hits your portfolio, we need to understand one mechanism first. The yen carry trade. Here's the simple version. For over 20 years, global capital treated Japan like an unlimited ATM, interest rates near zero, sometimes negative. You could borrow yen almost for free. And then what? You didn't hold yen. You converted it into dollars, into euros, and you poured it into US treasuries, tech stocks, crypto, anything that could go up and tell a good story. Japan became the water source, Wall Street became the pump, and asset bubbles became the containers. And this worked for a very long time. I went back through data to 2001. I reviewed old Bojay meeting records, and one pattern never breaks. When yen rates stay low, global risk assets expand aggressively. When the yen strengthens, global markets shake. Why? Because the position size is massive, trillions. So here's the real question. Why did the world's most reliable funding currency suddenly flip? Why does the yen stop supplying liquidity and start pulling it back? The answer is uncomfortable. This is not normalization. This is settlement, a reverse settlement of global carry trade. For years, US asset prices were held up by a loop, low funding costs, high narrative premiums. But once yen rates turn, capital starts asking new questions. Why take risk at US market highs? Why stay in volatile assets when currency adjusted returns at home are safer? That's how drainage starts, not panic. Not crashes, just quiet, rational withdrawal. At first glance, this looks harmless. People say Japan benefits, tech keeps rising, crypto still wins. But look closer. Assets that depend on liquidity to justify valuations don't survive a drainage cycle because valuation isn't profit. Valuation is cheap money multiplied by belief, and belief collapses when funding costs rise. So where does the money leave first? The Nasdaq high, multiple tech, the weakest free cash flow giants, because capital doesn't chase innovation. It chases rate differentials. Crypto suffers even faster. Bitcoin didn't rise because it was digital gold. It rose because leverage was free. Zero. Cost leverage disguised as philosophy. When funding costs rise, that leverage disappears. But here's the layer most people miss. Used treasuries for years. America relied on global capital to absorb its debt at low yields. Now Japan is effectively saying, my yields are higher, my currency is stronger. Why should I finance your deficits? And suddenly, refinancing pressure moves to the center. Rates don't fall. Liquidity doesn't loosen. Stress doesn't scream. It builds. And this is only the beginning. Because when Japan moves, global risk models react together. When the yen strengthens, one core variable changes. The global risk-free rate. In simple terms, the denominator in every valuation model gets bigger. Samey cash flows. Bigger denominator. Prices don't stay high unless cash flow is exceptional. Most aren't. So where does the money go? Not diversification. Repatriation. Out of dollar assets. Through FX conversion. Back into yen deposits. Japanese bonds. Domestic blue chip companies. This is a capital homecoming cycle on a historic scale. Why did the yen carry trade work for 20 years? Because it felt risk. Free. No one expected Japan to hike. No one feared yen appreciation. No one believed policy would reverse. It became a sleep. Income machine, but the operator changed. And the new operator has one message. Time to settle. This is not recovery. This is a margin call. No. Let's talk winners and losers. You think Japan's stock market wins? On the surface, yes, but dig deeper. Japan's giants depend on exports. A stronger yen compresses margins. Revenue rises. Profits don't, shareholders don't celebrate. What about tech capital doesn't ask? Is AI revolutionary? It asks, can your cash flow cover my funding cost? And then the dominoes fall. High, multiple tech first, story-driven growth next. Leveraged institutions after that. Are U.S. Treasuries safe? Number. They're not a sanctuary. They're the funding core. As foreign demand weakens, the U.S. must offer more yield and issue more debt. Rates stay sticky. Liquidity stays tight. So who actually wins? The boring ones. Energy giants, asset-heavy businesses, companies with brutal free cash flow, low debt, no valuation fantasies, because when liquidity drains, capital stops chasing growth and returns to yield. When the tide goes out, what's exposed isn't meme coins. It's valuation dependency. The most painful losses won't hit assets already in bear markets. They'll hit assets surrounded by optimism. People say Bitcoin hedges inflation. They say it's a new system, but Bitcoin runs on sentiment, not cash flow. When funding costs rise, money doesn't hide from inflation, it hides from volatility. So crypto sells first, to lock in yield. The most dangerous layer is psychological. Markets don't move because of models, they move because of fear thresholds. When carry traders realize this isn't a one-off hike, they don't wait. They exit early. Early exits create selling. Selling creates liquidity vacuums. That's drainage. And when institutions leave, who holds the risk? Retail. Because only retail is left asking, can it still go higher? The real danger isn't the drop, it's who catches it. This is not just a rate change, it's a 20-year regime reversal. And regime reversals penetrate everything: financing, debt rollovers, fiscal capacity, valuation systems. There are two core risks ahead. First, asset runs, not bank runs, asset runs. Everyone tries to exit first. Tech doesn't drift down, it resets. Crypto doesn't consolidate, it reprices volatility. Treasuries don't feel safe. They become contested collateral. Second, Rate zombie mode. Rates don't fall. Growth slows. Governments borrow more. Buyers hesitate. When monetary and fiscal forces pull apart, markets turn into survival games. So remember this. Drainage continues. US debt faces pressure. Valuations return to cash flow. Carry traders exit early. The window isn't months, it's weeks, maybe days. Ancien appreciation meets stalled-us yields. Machines execute. Algorithms don't wait. After a 5,000-word overnight analysis, I compiled a report called From Drainage Cycles to Valuation Reforging. It maps out 3 capital migration paths for the next 6 months and a logic-driven watch list. No hype, no emotion. To get it, go to the pinned comment and enter the code. Wealth Safety. First 1,000 only. Because when everyone wakes up, the cheap positions are gone, stable yields are locked, and volatility is already here. So let me ask you, is this a repair of the global system or a slow-acting emergency fix? Is it clearing minds for the future or borrowing time for the present? Write your answer below. Because how you understand capital migration cycles will shape your wealth for the next decade.